Welcome back to Mentor in 5. Today, we're diving into what many investors, including Warren Buffett, have called the greatest book on investing ever written, The Intelligent Investor by Benjamin Graham. This isn't a get-rich-quick book. It's not about stock tips, day trading, or magic formulas. Instead, it's about developing the mindset and principles of a truly intelligent investor, someone who can grow wealth steadily, safely, and rationally. In this video, I'll break down the main ideas, explain them with modern-day examples, and share how you can apply them whether you're a beginner or already investing in the stock market. So if you've ever searched for terms like best investing books, value investing explained, how to invest smartly, or Benjamin Graham's investment strategy, this video is exactly what you need. Who is Benjamin Graham and what is the core of the book? Benjamin Graham is often called the father of value investing. He was not only a legendary investor himself but also a professor at Columbia Business School, where he mentored Warren Buffett, who later became one of the richest men in the world, largely by applying Graham's teachings. The Intelligent Investor was first published in 1949, and despite being more than 70 years old, it's still considered one of the most important and practical books on investing. Warren Buffett has said, by far the best book on investing ever written. That's a huge endorsement, and it's why this book is constantly among the most searched investment books on Google and YouTube. Core philosophy of the book. The central message of The Intelligent Investor is this: right-finger investing should be more about managing your behavior and your risk than chasing high returns. An intelligent investor doesn't try to outguess the market's daily moves. Instead, they focus on buying investments at a price below the true value and holding them long enough to benefit from long-term growth. In other words, don't speculate, invest. Key concepts explained. This is where the book really shines. Let's break down its most powerful lessons. A. Investment versus speculation. Graham draws a clear line: investment, careful analysis, safety of principle, and an adequate return. Speculation, making bets based on price movements, market trends, or hype, with no real margin of safety. If you buy a stock because TikTok says it's going to the moon, that's speculation. If you analyze a company's earnings, assets, debt, and industry, and buy when it's undervalued, that's investing. This distinction is still highly relevant today, especially with meme stocks, crypto hype, and short-term trading dominating headlines. B. Margin of safety. This is probably the most important concept in the book. The idea is simple: always leave a margin of safety when you invest. If your analysis says a company is worth $100 per share, don't buy it at $95. Wait until the price is $70 or $60. That way, even if your analysis isn't perfect or the company stumbles, you're still protected. Margin of safety is like having airbags in your car. You hope you never need them, but they're there to save you when something goes wrong. C. Mr. Market. Graham introduces one of the most famous metaphors in finance, Mr. Market. Imagine you have a business partner named Mr. Market. Every day, he offers to buy your share of the business or sell you his. The catch: he's extremely emotional. Some days he's euphoric and offers crazy high prices. Other days he's depressed and offers dirt cheap prices. Your job as an intelligent investor is not to follow his moods but to take advantage of them. When Mr. Market is pessimistic and prices are irrationally low, you buy. When he's euphoric and prices are irrationally high, you sell. And most of the time, you just ignore him. This metaphor is timeless. It explains why markets crash, why bubbles form, and why patience is a superpower. D. Intrinsic value versus market price. Another key idea is that price is what you pay, value is what you get. The stock market often prices companies incorrectly in the short run, but over the long run, prices tend to move toward intrinsic value, the true worth of the business based on fundamentals. Your job is to calculate or estimate intrinsic value and only invest when market price is well below it. Think of it like shopping for clothes. Just because a jacket is priced at $300 doesn't mean it's worth $300. If you find it on sale for $120 and it's high quality, you've got a deal. That's how value investing works. E. Investor psychology and emotions. Graham emphasizes that the biggest enemy of the investor is often themselves. Fear, greed, overconfidence, panic, these emotions cause people to buy high and sell low. He stresses the importance of discipline and patience. You must resist the urge to react emotionally to daily market swings. This is especially relevant today with constant news cycles, social media hype, and apps that let you trade in seconds. E. Investor psychology and emotions. Graham emphasizes that the biggest enemy of the investor is often themselves. Fear, greed, overconfidence, panic, these emotions cause people to buy high and sell low. He stresses the importance of discipline and patience. You must resist the urge to react emotionally to daily market swings. This is especially relevant today with constant news cycles, social media hype, and apps that let you trade in seconds. F. Defensive versus enterprising investors. Finally, Graham explains two broad types of investors. 1. Defensive investor, passive, doesn't want to spend much time analyzing. Focuses on safety, diversification, and steady returns. Typically invests in index funds, bonds, and blue-chip stocks. 2. Enterprising investor, active, willing to put in serious effort. Studies companies in depth, looks for undervalued opportunities. Both approaches can succeed. The key is to choose the one that matches your personality, knowledge, and time commitment. 6. Strengths and weaknesses of the book. Strengths, timeless principles, they've worked for decades. Clear distinction between speculation and investment. Focus on risk management and psychology, not just returns. Endorsed and applied by Warren Buffett himself. Weaknesses, the writing style is dense, old-fashioned, and can feel dry. Some examples are outdated, companies and bonds from the mid-20th century. Doesn't cover modern asset classes like cryptocurrencies, startups, or alternative investments. But overall, the principles stand strong. 7. My personal takeaways. What I personally learned from The Intelligent Investor is that patience beats prediction. You don't need to know what the market will do tomorrow. You just need to buy good businesses at good prices and hold them long enough. The book also taught me that protecting my capital, avoiding big mistakes, is often more important than chasing big gains. And finally, it reminded me that markets are emotional, but I don't have to be. 8. Conclusion. So, is The Intelligent Investor worth reading? Absolutely. It's not a quick read, and it's not always exciting, but if you truly want to understand investing, this is the book that will shape your mindset for life. If you found this video helpful, please like, subscribe, and hit the notification bell so you don't miss future reviews of the best books on investing, finance, and business. And let me know in the comments, right finger, have you read The Intelligent Investor? Right finger, do you want me to review books like Rich Dad Poor Dad, The Psychology of Money, or Think and Grow Rich next? Thanks for watching, and remember, in investing, intelligence is more about temperament than IQ.